We're analyzing MercadoLibre stock ticker MELI to see if it's a buy now. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for MercadoLibre. Then we're giving a final rating to the business. Before we get into these valuable metrics, let's understand MercadoLibre's stock performance. MercadoLibre is owned in the portfolios of super investors Lee Ainsley and Poland Capital Management. Right now, it trades for $1,242.52 per share. Year to date, their stock is crushing the market. They're up 50%. In the last 5 years, they're also beating the market. MercadoLibre is compounding at 28% annually. In the last 10 years, they're compounding at 26% annually. Since going public 16 years ago, just before the global financial crisis, MercadoLibre is compounding at 26% annually. They've been one of the top performing stocks throughout this time. The business trades $100 below their 52-week high. They're trading about $500 above their 52-week low. Around 2% of their shares are sold short. MercadoLibre is a big business. They have a $62 billion market cap. But the burning question is, why should we be paying such close attention to MercadoLibre? The company runs the largest e-commerce marketplace in Latin America, connecting a network of more than 146 million active users and 1 million active sellers as of the end of 2022 across an 18-country footprint. The company also operates a host of complementary businesses with shipping solutions, a payment and financing operation, advertisements, classifieds, and a turnkey e-commerce solution rounding out its arsenal. MercadoLibre generates revenue from final value fees, advertising royalties, payment processing, insertion fees, subscription fees, and interest income from consumer and small business lending. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. The average business earns a 7% return. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. MercadoLibre has turned the corner and they've had positive returns on capital since 2020. They've been increasing in each of the last 5 years. In their last 12 months, they earn over 18% returns on capital. This is good as the company is finally getting into a stage of consistent profitability. Even better that their returns have been increasing and this hasn't just been a fluke for the business. While averaged out, they're only earning 3% returns. This average doesn't tell the full story. The company looks good if they can keep up their current numbers. There's more nuance to the business than what their average reflects, but because we're looking for an average here, this is an X on metric number 1. Metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth. We want this growth to support their returns on capital. We're looking for this across the board. All 3 need to be up for it to be a check. In this time, MercadoLibre's experienced huge growth. Their revenues have increased by more than 8 times. Their net incomes were negative up until 2020. Since then, they've been positive. A good sign for the business, they've had positive free cash flow in all 5 of these years, and their free cash flows are up big, growing more than 20 times in the last 5 years alone. This is a huge check on metric number 2. Metric number 3, we're looking at MercadoLibre from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. In this time, we learned their earnings or their net incomes have swung from being negative to today they're positive. At the same time, the company's diluted shareholders by 16%. That's not out of the ordinary for these big growth software companies, especially for marketplace businesses. It is something to note though, especially as the company gets into a more stable, more profitable point in its history. Still, because their earnings went from negative to positive, there's no amount of shareholder dilution that could offset this. This is a check on metric number 3. Metric number 4, we want to see free cash flow per share growth. As we learn, their free cash flows have grown by a lot. This is also outpacing their shareholder dilution. This is a check on metric number 4. To recap where we stand currently, through 4 metrics, we have 3 checks and only 1 X for MercadoLibre. How will the business fare in the back half of our analysis? But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets MercadoLibre apart, which is having these without using a lot of debt. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Right now, MercadoLibre has about $2.2 billion in net debt. They ended last year with $2.4 billion, so they paid this down some. In these last 5 fiscal years, they produced positive free cash flows in all 5 years. When these are summed up, they produce about $4.3 billion of free cash flow over this time. That's about double their current net debt position. It looks like they're able to support this pretty comfortably. This is a check on metric number 5. MercadoLibre looks like it's in a solid financial position based on their free cash flows. In their last 12 months, which aren't shown on this chart, they produced $4.1 billion of free cash flow alone. They'd be able to pay off their entire net debt position with about 6 months worth of free cash flow. The big metric of them all, metric number 6, we want MercadoLibre's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for MercadoLibre. Right now, the business has a $64 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at MercadoLibre similar to it being a private company. In the last 5 years, we learned they produced $4.3 billion of free cash flow, meaning in an average year, they produce about $850 million of free cash flow. When that's divided by their enterprise value, we get around a 1.3% average free cash flow to enterprise value yield. Keep in mind the averages for this business, due to their high growth, don't tell the full story. On a current basis, MercadoLibre produced $4.1 billion of free cash flow in their last 12 months. When that's divided by their $64 billion enterprise value, we get around a 6.4% current free cash flow to enterprise value yield. That's both above the yield of the 10-year treasury and the risk premium we're looking for. Again, because we're looking on an average here and free cash flows can be lumpy year to year. This is an X on metric number 6. Don't just throw the business out. We still need to estimate their fair value per share and talk about our final rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze MercadoLibre, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Even though MercadoLibre has been public for more than a decade and a half, they have a low degree of business predictability, in part due to their huge growth in the last decade. This impacts our assumptions and can give us a rougher estimate than would be the case for some other businesses with a more stable, less high growth trajectory. We're taking an average of their last couple years of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for the business. Assuming they grow these free cash flows at a rate of just under 13% annually for the next decade, then in the following decade, assuming this growth rate's cut in half and they grow at 6% annually, we're adding in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if these are the same 20 years into the future, an estimate of MercadoLibre's fair value is around $970 per share. That's down $300 from their current stock price, but it's well within the range of where they've traded in the last 52 weeks. Keep some key points in mind. Again, the business has low predictability due to their high growth. This discount rate is an estimate of total returns to shareholders based on their free cash flows. So far in the business's history, their returns have primarily come from multiple expansion, with only part of their return coming from the actual business performance. There are still high growth rates built into this business for this valuation to make sense. You'd want to dig into the company's filings to understand their growth trajectory into the future. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to MELI, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for this business. Why don't we find out what they are? Looking at the factors supporting a long thesis, number 1, consumer and small business lending addresses a key pain point in traditional finance service offerings while tying merchants and customers more closely to the MercadoLibre platform. Number 2, the scaling of a first-party sales business allows MercadoLibre to compete more effectively during key holiday seasons with strategic discounts of anchor products. Worth noting, e-commerce giants like Amazon are increasingly trying to move away from their 1P business and are working to more heavily facilitate a 3P marketplace. Number 3, surging digital payment adoption and increasing acceptance of online shopping should underpin durable secular growth for MercadoLibre. But it wouldn't be fair if we didn't cover the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, government-funded solutions outside of the conventional ACH transfers and debit payments, particularly in Brazil through Pix, could apply downward pressure to take rates in the fintech business. Number 2, a devaluation of the Argentine peso, would severely curtail that region's contribution to sales growth, though operating income and net income remained largely hedged. Number 3, linguistic, trade, and cultural idiosyncrasies complicate cross-border selling in the region, resulting in the maintenance of separate marketplace properties in each country. There you have it for a balanced perspective of some of their qualitative factors. Now let's talk about our rating. In analyzing MercadoLibre's stock ticker MELI, we learned this high-growth Latin American e-commerce market seems to have rounded the corner in their business. They've been consistently profitable for each of the last 3 years, both on a GAAP and a non-GAAP basis. The company's generated a lot of free cash flow in their last 5 fiscal years, generating positive free cash flow in all of them. They also have strong returns in their last 12 months, and they have a lot more free cash flow generation in that same time than where they were at historically. This is on the back of their high growth, which has seen their revenues increase by more than 8 times. The company is also using modest amount of debts compared to the free cash flow they're generating. Keep in mind, this again is not financial advice. When we looked at their free cash flow to enterprise value yield, their average wasn't attractive compared to the yield of the 10-year treasury, but their current was. That was the same when we looked at their returns on capital. So this is a company you'd want to dig into and really understand if their growth is going to be durable into the future or not. When we performed our discounted cash flow analysis from today's valuation multiples, if these are the same 20 years into the future, you believe those assumptions and you want a 15% rate of return, an estimate of MercadoLibre's fair value per share is around $970. The business last traded at those levels at the start of 2023. You'd want to be patient. Looking at all the factors of our analysis, MercadoLibre looks like a strong candidate for further research. Dig into the business if you're interested in learning more. Thanks for learning about MercadoLibre with me. Subscribe to the channel and check out this next video.